So what is a surety bond and why are you being told that you need one? A surety bond is a obligative document that helps small business secure contracts with third parties. And that contract could be a sales contract. It could also be a license contract. If you're a company that gets certain types of licenses like a CPA or an attorney, your licensing bureau might be telling you you need to get a surety bond in order to get that license. So that's a form of a contract. Small business owners can use a surety bond as a tool to help get licenses and also to get more business. It allows a third party, like the licensing bureau or a client, recoup money from you if you fail to abide by the terms of your license or contract. Surety bonds have many different applications depending upon what you're using them for. Contractors can use them to make bids to large organizations. So if you're a small contractor and you want to bid on a job, let's say for a college to build a new deck on a building, and that college says, well, we'd like to do business with this small contractor, but if they don't show up or if they do a bad job, we don't know if they're going to have any kind of capital reserves or money to fix the problem. So we want a surety bond. The most common reasons that bonds are used are for licenses, contracts, and sometimes even fiduciary responsibility. So if you're an accountant like a CPA and you rip somebody off, they have a bond that can help recoup their money. Unlike other types of contracts, a surety bond has 3 parties to it, not just 2, it has 3 parties. There's the principal, which is you, the person who purchases the bond, to guarantee to somebody else that you'll fulfill the obligation. And that obligation could be to comply by the contract, payment of money, performance, that kind of thing. Then there's the obligee. That's the party that's requiring you to buy that surety bond. And they do that to make sure that you fulfill whatever promise is being guaranteed under the bond. Promise to pay, promise to finish a job, promise to use your license in a certain way. The obligee could be your client. It could be a customer. It could be a government agency. It could even be a court. Sometimes courts require bonds for appeals of verdicts. The third party to a surety bond is what's called the surety. That's an insurance company that's a neutral party to the transaction. They're not part of your deal. They don't have any benefit from your contract or license. What they do is they guarantee that you, the principal, will perform the obligation, perform the promise in the bond, and they create a certificate that you give to the obligee, and that certificate is their kind of golden ticket that you're going to do the right thing. If you fail to deliver or fail to do what's in the contract, the surety will then pay out a claim to the obligee. They will make them whole. They will make them good. Or at least pay what was described under the surety bond. So that's what their benefit is as an obligee. They get somebody with deep pockets, the insurance company, that will pay them out. Now, it doesn't end there. If you are the principal and you have a claim against your bond company is going to pay it, but you're not off the hook. The surety will then come back to you to recoup that money. It's not like an insurance policy where, look, if you have car insurance and you crash into somebody, they pay to fix their car and then you're off the hook. The surety is simply a payment mechanism for that beneficiary. They get the money, but now the surety comes back after you, and you say, wait a minute, that's not fair. I paid for the surety. Well, here's the difference. Your car insurance, using the same analogy, you pay every year a very high premium, hundreds, probably thousands of dollars. The surety you pay one time, and usually it's a small amount. Most sureties are several $100s. So that is not necessarily for a loss payment reserve. It's just a fee for them to be the front man for the money, the deep pocket for the money, to make the obligee whole, and then they come back after you. Here's a few types of bonds that are available, and some of these you may have heard of. Some of these are the reasons you might be watching this video. One is a performance bond. A performance bond protects your client from financial loss if you as a contractor fail to perform the contract as written in the terms and conditions. And if you have specifications in that contract, you have to meet it per those specifications. Another type of bond is a bid bond. This guarantees that you as a contractor has submitted a bid that you will perform upon, and you'll honor that. So if you're accepted as the vendor for a contract, you have to follow through on it. And if you don't, the obligee can now collect on that for any damages they have. The third is a payment bond. Payment bond guarantees that the contractor will pay subcontractors. So let's say if you're a general contractor on a construction project and you get paid 100% from your client for building a new addition on a hospital, and you don't pay your subcontractors, the electricians, the plumbers, the framers, all the engineers, well, those subs could now put liens on the building against the client, even though you got paid 100%. So the payment bond guarantees that they're not going to be paying for a job twice. Other types of surety bonds are completion bonds. It certifies that you're going to complete the project within budget and without those kind of liens we talked about. The most common types of bonds have to do with what we talked about. That's why you heard us mention general contractors, commercial contractors. But there are other bonds too. If you're a licensed business like car dealers, they have to get a bond to make sure they don't rip people off. If you're a mortgage broker, you have to be bonded so that your activities don't harm consumers in a way that they might need financial compensation. So how much of a surety bond do you need? Well, normally that's going to be dictated by the purpose of the bond. If you have a license you're applying for, let's say you're applying for a CPA license, the Bureau of Licensing and Enforcement for the state issuing that particular credential is going to dictate in their rules you have to have a surety bond for a minimum of, let's say, $50,000. That's how much your bond will need to be in effect for. If it's for a contract, the contract itself will dictate how much the bond has to be for. How long does it have to remain valid? Well, it remains valid for the length of time that risk is incurred by the obligee. So if it's a license bond and your license is for 3 years, your bond has to be in effect for 3 years. If it's a contract, it may have a certain period of time where you're liable for defects or liable for payments to vendors. And how much do these bonds cost? Well, usually it's a percentage of the amount. Usually it's a small single-digit percentage. One type of bond we see quite a bit are vehicle title bonds. If somebody has a vehicle they need to get a title for and they don't have the right paperwork, the DMV or licensing bureau sometimes will allow you to obtain a vehicle title without having the old paperwork properly assigned if you have a surety bond. Those surety bonds cost 1 or 2% of the value of the vehicle. So those are the kind of numbers we're talking about. In that case, it might be a couple $100. For a surety bond for a license, same thing, might be $100 or $200 for a $20,000 or $30,000 bond. For larger bonds for a $10 million construction project, you can be talking thousands of dollars. Check with your bond producer to see if there are availability of a surety bond for your need, and they can tell you the exact amount. The good news is the bond amounts are usually fixed by filing with the surety agency, so it's not going to be a big variation from one place to another, and it's not a very difficult process to underwrite these. You have to fill out some forms, maybe put your financial information on file, your experience in that type of activity on file, and then the underwriter and the agent will write your bond, give you your certificate, and you can give it to your third party. Put your comments below, let us know what you think, and we'll see you on the next video.